In part 3 of the video, we have learned about how to account for an increase in the allowance for impairment of trade receivables in the second year. We will now look at what the business needs to do when it needs to decrease. The allowance for impairment of trade receivables at the end of the third year. The journal entry that has to be recorded will be debit allowance for impairment of trade receivables, which will reduce the contra asset, and credit impairment loss on trade receivables, which will reduce your expense. Let's look at example 3. Now in example 3, we continue from example 2, which on 1st of January 20x3, the allowance for impairment of trade receivables had a balance of 720. Now the following took place in August 20x3. On August 10, Caesar Cafe paid in full the amount it owed of $280. On August 15, Jolly Sweets continued to suffer losses and closed its operations. He then paid $200 out of his total debt of $440. The remaining balance is to be written off. Now an allowance for impairment of the amount owed was made on 31st December 20x2 of $440, which you can see in example 2. Now on 31st December 20x3, Ice Jelly estimated that only one debtor is unlikely to be collectible. The amount owed was $360. The total trade receivables on 31st December was $12,000, and you are asked to do the following. Now to prepare the journal entries to record the transactions on 10 and 15 August, let's take a look at what transactions they are. For the one on 10 of August, the business made an allowance for impairment of trade receivables for Caesar Cafe in 20x2. But the debtor managed to pay up the full amount that he owed. For the transaction on 15 August, the debtor had to close, but he paid part of the outstanding debt. So for the transaction on 10 of August, even though an allowance had been made for Caesar Cafe before, do take note that we do not reverse out the allowance for impairment account, even though the debtor managed to pay. Instead, we will do the following, the usual recording when a debtor pays up, which is you debit cash at bank, and you credit trade receivables, Caesar Cafe. The date will be August 10. So you debit this by 280, you credit this by 280. Now for the transaction on 15 August, we have to record the partial payment that was received from Jolly Sweets first. So on August 15, you have your debit cash at bank because you received $200 from Jolly Sweets, so debit 200. But you should notice that the amount owing by Jolly Sweets was $440, so it means that after the debtor paid $200, there is still a balance of $240 that was $240 that is still remaining. And since the debtor will not be able to pay anymore, we have to write off the remaining amount. So we will debit allowance for impairment of trade receivables for $240 and we will credit the whole amount of trade receivables from Jolly Sweets, which is 440. For the trade receivable account for Caesar Cafe, we record the balance brought down first of 280. So balance brought down January 1st, balance brought down of 280 debit. Then on August 10, the debtor paid up, so we will credit this trade receivable account for 280 and write cash at bank here, since this is the account that we debit. So the balance will be 0. Now for the trade receivable account for Jolly Sweets, again we record the balance brought down first. So the balance brought down was 440 debit. On August 15, he made a partial payment of $200. So we credit the trade receivables by 200 and write in the balance of 240 debit, and we write cash at bank here. However, you note that this $240 will be uncollectible and has to be written off. So we credit this account by 240 and debit allowance for impairment of trade receivables. And the account will be reduced to 0. So a reminder again, when a debtor is only able to pay off part of the amount owed and the uncollectible portion is to be written off, we will write the journal entries as follows. For the amount collected, we will debit cash at bank or cash in hand and credit trade receivables. For the amount to be written off, we will debit allowance for impairment of trade receivables and credit trade receivables. Now let's take a look at the allowance for impairment of trade receivables account. So we start with a balance brought down of 720 credit from the previous year. Now during the year, only Jolly Sweets went bankrupt, but he made a partial payment before it closed. In the allowance for impairment account, we will only record the part that the debtor cannot pay. So we will debit allowance for impairment of trade receivables for 240. And credit trade receivables Jolly Sweets for 240, not 440. So at the end of the financial year, before that, the balance here will be 480 credit, and this is August 15. Now, at the end of the financial year, 31st December, the business estimated that the uncollectible amount is $360, means the required ending balance of the allowance has to be 360 credit. So we write 360 credit. That is the required ending balance. Now take a look at the balance before the end of the year, which is 480 credit. Hence, we have to decrease the amount from 480 credit to 360 credit. In order to do this, we will debit allowance for impairment, which is this account of trade receivables, by 120, and credit impairment loss on trade receivables on December 31st. So lastly, we will bring down the balance 20x4 January 1st, balance brought down of 360 credit. Now, when we look at the income statement, we have to be careful that even though impairment loss on trade receivables has a credit balance, we cannot treat it as an income. Instead, it is called reversal of impairment loss on trade receivables, which is to be deducted from the other expenses in the income statement. So under less expenses, we will write here reversal of impairment loss on trade receivables. And we'll put 120 in a bracket here. Now for the extract of the balance sheet under current assets, we will still record the total for the trade receivables of, so trade receivables for 12,000, then less the allowance for impairment of trade receivables of 360, and you have your net trade receivables of 11,640. Now the chart below shows the analysis of the changes in the allowance for impairment of trade receivables account and the impairment loss on trade receivables account. Now on the first year, which is 31st December 20x1, the business creates an allowance of 600 credit. Now during the year of 20x2, there were changes in the allowance because there were some debts written off. The balance before the end of the year was 250 credit. However, the business decided that at the end of 20x2, $720 is unlikely to be collectible. Hence, there is an increase in the impairment loss on trade receivables by 470, which is the difference between the two. And the expense will increase by 470. Again, in the year 20x3, there was a write-off of 240, resulting in the balance before the end of the year being 480 credit. which is higher than the required ending balance of 360 credit. Hence, there is a credit in the impairment loss on trade receivables, which will decrease the expense for the year. Now, what are the effects of the changes in the allowance for impairment of trade receivables and the impairment loss on trade receivables on the profit for the year? Let's examine the effects from examples 1 to 3. In 20x1, the first year of operation, we debit impairment loss. On trade receivables for $600, and we credit this account allowance for impairment by $600. As impairment loss on trade receivables is an expense, a debit means that the expense has increased. When expense increases for the year by $600, the profit will decrease by $600. In the second year of business, 20x2, we debit impairment loss on trade receivables and credit allowance for impairment of trade receivables by $470. So similarly, the expense will increase by $470, resulting in the profit decreasing by $470. Now in the third year, we debit allowance for impairment and credit your impairment loss on trade receivables by $120. Take note again that impairment loss on trade receivables is an expense account. So when you credit an expense account, you are decreasing the expense. When the expense decreases by 120, profit will increase by 120. So in summary, when the allowance for impairment of trade receivables has to increase after all the write-offs of trade receivables, impairment loss on trade receivables account will have a debit balance. Debit balance means increase your expense, so profit will decrease. Now when allowance for impairment of trade receivables has to be decreased after all the write-offs, impairment loss will have a credit balance. Credit balance means expense decrease, so profit for the period will increase.